Hi everyone, I'm the Tax Pro, and today is day 14 of our 90 Days to Taxes series. In this series, I'm helping new business owners or business owners who may be disorganized and helping you get organized and get ready for tax season. So in this video, we're going to talk about revenue, and we generally have been talking about expenses. We're going to also touch on other expense categories in future videos. But today I want to talk about revenue because I don't think that it's covered enough, and I think that it's confusing for some people. So when it comes to revenue is going to be, what you bring in cash-wise to your business for different activities. So we have our operating activities where we are, selling products or we're providing services or something along those lines. But you may also earn income from other sources, things such as having a savings account and earning interest or selling assets from the business. And these specific types of revenue activities need to be separated in your books because they oftentimes go on different areas of your tax return. So, for example, you are going to have your operating revenue, and I'll go over how I break that out here in a minute, but you may also have interest income. And interest income is taxed differently than general operating revenue. The reason being is because it is not subject to self-employment tax, but it is potentially subject to the NIT tax, which is the net investment income tax. Okay, so when we look at Form 1120S, this is your S corporation tax return. There is a separate area to put interest income right here on line 4 of Schedule K. Okay, because it sits in a different area than ordinary business income. Now, you'll also notice that dividends are on here. And notice that we have to separate dividends out by ordinary and qualified. Qualified dividends, those are a type of dividend that has a tax advantageous treatment. Okay, so you would know based on the business that you purchase whether or not it's qualified dividends. If you get a 1099 DIV from the company that has paid your business dividends, and keep in mind this is the S corporation owns stock, not you personally. Okay, the business itself owns stock. It's going to have that 1099 div will have a separate area for those qualified dividends. So you'll know if they're treated advantageously for taxes. Okay, so you have ordinary dividends and qualified dividends. Royalties need to be separated out. You may have royalties, let's say that the company produced a book or something along those lines. You get royalties for those sales. Is it something that you essentially put work into and then there's not a lot of work that happens after that? And I'm not saying that writers don't do work after they've published a piece of work, obviously. It just looks different, the type of work. So you may have royalties in there. That needs to be separated out. Rental income is often different than general operating income. So if you have rental income, but then you also are selling products or providing services, that needs to be separated out. Your profit from selling assets has to be separated out. So all of these are different categories on that chart of accounts. All of these are different categories that are going to sit on your profit and loss. Okay. Now, when it comes to your operating income, so you're selling products or you're providing services, you may also want to separate those out. And the reason, for a couple of different reasons. So you may want to separate them out into what is subject to sales tax and what's not subject to sales tax. That can sometimes help people prepare their sales tax returns. If the revenue is broken out between taxable and non-taxable items, you would determine whether or not it's taxable for sales tax based on your state. Okay, so different states have different regulations on what is and is not taxable for sales tax. They may also have different rates depending on the product and or service. Okay, so you may want to have a taxable versus non-taxable. You may want to divvy it out products versus services, whatever is going to give you the information that you need in order to properly run your business and get business insight. So really important that you break out these other investment items though. Now, when you record revenue, a common mistake that I see is you're using a payment processor and you go in and the payment processor charges 3%. So if you've made $100,000 in the business, if you take out 3%, you really only got $97,000 deposited to your account. You have to report the $100,000 as revenue. Okay, you have to report the $100,000, and then you record a $3,000 payment processing fee expense. Okay, the reason being, so it still comes out to $97,000, but the reason that you have to do that is because that payment processor is going to issue a 1099-K to the IRS. And they're going to tell the IRS, hey, this taxpayer, this business collected $100,000 this year. And if your top line revenue says 97, the IRS is going to think you're off by 3,000. Okay. Now, in reality, I get it. That amount is what came into your business account. That's what got deposited to you. But you need to report the top line and then report the payment processing fee as an expense so that you're reporting that full amount of revenue. Okay. The other thing to keep in mind before I finish the video is with dividends. You want to make sure that you are tracking dividends from companies that you own a small percentage of stock in, separate from dividends where you own 20% or more of the stock in that business. A reason being is because there's different reporting requirements. So this is the S corporation tax return. And if you go up here, you're going to notice, did the company own 20% or more or 50% or more of the total stock, okay, of a business? And then you may need to know the amount of revenue that was generated from these closely held companies. Same thing on Form 1120 for C corporations. Dividends from less than 20%, dividends from 20% or more. Okay, so you need to divvy these out. So the best thing to do is to look at your tax return that you're going to be filing for the business and make sure that you can fill out all of the information on there. Now, in all likelihood, the majority of you are not dealing with dividends for companies that you own 50% or more of or 20% or more of. I just want to point it out there that use your tax return to help you divvy out that revenue and break it out into ways that you can easily go, okay, this is the total for this category. It goes on this line on my tax return, okay? Any other breakout that you do needs to be for simplicity's sake when it comes to managing your sales tax filings or for you to get the information that you need for things like running your business. So hopefully that was helpful. If you have any questions, please let me know. If this was helpful, I would appreciate a like and subscribe, and I will see you guys next time.